Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions featuring the proprietary bull-bear point and figure market breadth summary chart for November 11th, 2018. Market breadth. With this past week's market fractional advance, our bull-bear point and figure ratio at 0.72 fell slightly from 0.76 last week. The total count of securities in bullish or bearish patterns decreased 8% to 2,736. The count of bearish stocks decreased 6%, while the count of stocks in bullish patterns decreased 11%. The Pirls P&F Market Breadth Summary Chart shows us a market now 9 weeks in bearish territory. Paid subscribers have access to the OpenOffice Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary via email, free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 218 points for the second advance in 10 weeks. At a negative 725.30 points, it continues below all 8 tops above plus 100 in the last 30 months, and it continues below 4 of the 5 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 3 accumulation days and 1 distribution day. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in distribution mode on higher average daily volume. Momentum. The CCI 20 daily is now at 16.15, up from a negative 18.85 last week. The CCI 20 daily, in a Woody's downtrend but with 3 days above zero, is currently falling within the plus or minus 50 range required for a valid zero-line reject entry signal, but would have to reverse direction and form a zero-line reject pivot within this range in addition to falling below zero so as not to shift into a Woody's uptrend. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 131 weeks ago, while the daily CCI 20 began a Woody's downtrend 4 weeks ago. The CCI 20 weekly rose to a negative 103.96 from a negative 178.75 last week. It is now 5 weeks below zero and continuing below the plus or minus 50 range required for a valid zero-line reject long entry signal. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and only one of the bottom 5 is negative. Summary: some tech and retail on the top. Oil, oil services, gold and silver and REITs on the bottom. Bullish, oil, oil services, and gold and silver continue in the bottom 5. Disk drives, computer hardware, and S&P retail have entered the top 5. Bearish, REITs has entered the bottom 5. KBW Bank and brokers have left the top 5. Focus this week from www.northmantrader.com. Weekly market update. Battle lines. The following are some key points and charts. there are a lot of people expressing certainty about the rest of the year. For most, the next move is higher, as they are expecting a massive seasonally based rally, especially if the Fed holds off on raising rates in December. Some are coming out and predicting a sell-off and a bear market to evolve. While I'm in the latter camp in the longer term, I'm currently in the perhaps lonely flexible camp. The reason: these markets have been acting very technically and have very much respected levels and pivots, and as such, they currently offer possibilities for both sides of the year and argument, but neither technical case offers a clear direction yet. What we are witnessing now is a battle for control, and hence we are in a tactical phase, while technical patterns are evolving. As I stated last week in Back with a Vengeance, but, quote, I think it's fair to say that many participants are looking forward to a bullish interpretation, especially if the historic script plays out, which is that the ruling party will lose the House, end quotes. And that's indeed what happened, with Democrats taking over the House as expected. Gridlock brought in buyers. And this trigger served to achieve what the counter rally needed to get accomplished: reconnect with key MAs, trend lines, and fib levels, which suggested highly probable major resistance and a fade opportunity. As I outlined on Twitter specifically, the 2016 trend line would offer resistance, and that's precisely where we rejected on Friday. And from a technician's point of view, this was a beauty, and it highlights two very important points. This market is acting very technically, and this broken trend line is now confirmed as resistance, and it is rising steeply. The bearish case: if bulls can't recapture this trend line, they risk falling hard off of this trend line and face a possible retest of lows, which could spark a W bottom. The new low scenario could be very consequential for several reasons. Firstly, as you see in the chart above, the recent correction has not even retracted to the larger fib levels since the 2016 bottom. The nearest major fib level is at 2,508 on SPX, which would bring us to new lows for the year. If this market resolves bearishly, that level may or may not get hit in 2018, but it's possible. In 2007, that drop off the new highs produced a counter rally that reconnected with the monthly 5 EMA, but then failed. This counter rally here just now also reconnected with the 5 EMA. As it's early in the month, it is too early to tell whether it will fail, but I note the structure for a possible major topping pattern remains currently in play. But bears have to prove their case. Also keep in mind the critical juncture markets are at. While the 2009 trend line was saved into the end of October, this trend line keeps rising steeply, leaving very little room for error here. Even a retest of the lows would put this trend line at grave risk of breaking, in which case the macro fib retrace opportunity becomes a monstrous one. The reversal on Friday certainly respected the 0.618 fib and leaves room for this inverse scenario. Was this retraced? Too early to tell, but note the inverse pattern has room for a larger retrace, and while it can drop as low as 2,712, it is the 2,735 area I suspect would be a major battle line. Ironically, note the deeper retrace now into these levels, the potentially stronger this pattern would be. Only if this inverse fails and we break below the outlined levels would then bears have a shot at a retest of lows or new lows altogether. So let's be clear, if this potential inverse pattern were to confirm, and that's a major if at the moment, its pattern target would be 3,035, which would curiously match up with the major macro fib we've been watching all year. This scenario leaves room for a grand finale to this bull market. Not saying it would happen this year. It could extend into early 2019, and a Fed caving in December may certainly be an impetus to achieve this. Bottom line, we're in a period of uncertainty while this battle for control is being fought. Thank you for watching this week's Santu Pirls Stock Market Commentary video featuring the proprietary bull bear point and figure market breadth summary chart compiled by Donald Pearl, www.s2pmarketsignal.com. For Santu Pirls Stock Market Commentary, I'm Cynthia Pearl, hoping that you have been enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.